for all things land development, planning and property. This is Property on Fire with Ian Walmsley. To find out how Ian can help you, visit propertyonfire.co.uk.
Hello and welcome to this week's episode of Property on Fire. So what do we have coming up on today's episode? As usual, several of you have been emailing in your questions to ian@propertyonfire.co.uk, and this episode is no exception. We have questions this week about an extension and whether Mark can actually do what he's wanting to do, and Jack has a query on whether he can still convert a residential property into an HMO. Also coming up, I'm joined by Darren from Acumen Finance, who will be giving us our monthly update on the property markets. So without further ado, let's get started. But before we do, please do like, review and subscribe to this podcast and come with me on this property journey. Before we jump into our first question that has been sent to @PropertyOnFire on Twitter, the government last week released a consultation paper for their plans for the General Permitted Development Order come July 2021, or the GPDO for short. In his Build speech at the end of June, Boris Johnson said that he wanted to create additional housing by converting a range of commercial locations to residential. In September, he started this process by adjusting the use class order to put many of the different uses into a new use class. This was use class E, or as they called it, commercial, business and service. This new use class now includes shops, offices, banks, gyms, doctors, dentists, creches, nurseries, light industrial, etc., and several more. That process is likely to be developed further by altering the GPDO, and this consultation paper lays out their plans, and the government is inviting you to respond and give your views on whether this is a great opportunity for developers in 2021 and beyond. The main crux of the consultation paper is the ability to convert any property in use class E to residential. Yes, you heard me right. Any property that is currently in use class E, so any of those I mentioned earlier, to residential. So you can take a restaurant, shop, banks, dentists, gyms, and all those and convert any of those to residential from the 1st of August 2021. This would replace and build upon Class O, office to residential, and Class M, shops to residential. One of the bigger issues with Class O and Class M is that they are both date stamped. In other words, they needed to have existed back in March 2013 for both these. And like me, you probably do not have the ability to go back in time. So anything constructed in the last 7 years can't enjoy these PD rights. This new proposal, therefore, is going to bring many existing buildings into play. So perhaps there's a few opportunities there for you to go and start looking for these types of buildings now, rather than waiting until it becomes live in August 21. The other limiting factor currently is that Class M is limited to 150 square metres. This proposal is to have no limits. Probably, I guess, due to larger offices. It would be rather hard to put a limit on offices, whereas use class E allows for flexible changes within it. And so if offices had no limits but shops did, by converting a big shop to an office and keeping it in use class E, that shop would now have no limit as an office. Therefore, I don't believe they can just limit part of it to a certain size. It's proposed that the new PD right will apply in conservation areas just as Class O does now, but not in areas such as AONBs, triple SIs, etc. Cities such as Bristol are virtually all conservation area, and therefore excluding conservation areas would have a big limit in towns and cities like Bristol, where you wouldn't be able to convert anything under use class E to residential. So I do think they have to have this applying in conservation areas. As in any conservation area, and indeed in non-conservation areas, anything external is probably going to still require a separate planning application, as it does now for Class O. The proposal is to check against all the usual checks and balances such as flood risk, contamination, highways, etc. Although there is a new proposal in there of fire risk, but my feeling is that this is more of a building control matter rather than planning, So I'm not sure if that's actually going to make it through to the full legislation. We'll just have to wait and see. There is one change to fees. Currently, the application fee is £96 per application. The proposal is to change this to £96 per dwelling, but with a cap at 50 dwellings. Reading through the consultation paper, I can see no mention made of Class G, which is 2 flats above a shop or bank, etc. So we'll have to wait to see if this is going to remain or whether it will go. I'm hoping that it will get expanded to 2 flats above any use class E use, but we will have to see. Maybe Class G will be subject to a prior approval. Currently, you do not need the permission of the local authority to go ahead and do it. You just need to comply with building regs, etc. This consultation is only running until 28th of January 2021, so the government is clearly wanting to just get this sorted. I have put a link in the show notes to both the consultation paper and also to where you can go to show your support or give other comments on the proposals that have been made this week by the government. Following last week's episode on banks, I've had quite a few comments on social media about people's preferences as far as banks are concerned. It certainly seems that most of you do like Starling Bank and have banked with them for a while. But others quite like the cards that are issued by other banks, so the jury is still out on some of them. If you missed last week's episode, why not go back now and have a listen to it and let me know your thoughts at Property on Fire, either on Twitter or on Facebook. Now on to our first question this week, and that was tweeted to at Property on Fire by Mark, and he's got an extension, or should I say he's planning to put an extension on the back of a residential house. The one issue he has is that he's got a very old outbuilding that has been in existence probably before 1948. And Mark's actually asking as to whether he can actually join the extension onto this outbuilding in his rear garden. Unfortunately, Mark, you can't. You have a maximum depth under permitted development of either 3 metres or 4 metres, depending upon whether it's a semi-detached or a detached property, or indeed a terrace house. And your issue is that if you actually joined that extension onto the existing outbuilding, the depth of your new extension will exceed those limits. So if you've got an outbuilding that has a depth of, say, 2 metres, and your gap between your existing house and that outbuilding is, say, 3 metres, if you join them together, your new rear extension is going to be 5 metres and not the 3 metres infill that you would be doing. So you can't actually join these together unless the overall depth stayed within the 3 metre or 4 metre limit, which in your case I don't think it does. So the question has to be as to how small that gap can actually be between the buildings. I've seen appeals won on as little as 50 millimetres. So the gap does not have to be very big at all, but there does have to be a gap. The gap is not defined anywhere, and therefore people have managed to have a very, very small gap. 50 millimetres is not exactly much, is it? So I hope that answers your question, Mark, as to what you can actually do with your existing outbuilding and with the extension that you are planning. I hope it goes well, my friend. Our second question is from Jack, who has asked, can he still convert his residential property into an HMO after an Article 4 has come into effect? Right, Jack's problem is that he was actually advised incorrectly, I feel, by the local authority or by one person as to how he can actually do the modifications on his property and still convert that into an HMO even after the Article 4 has come into use. Unfortunately, Jack, you can't. Class L of the GPDO goes from a C3 to a C4 in your case, or you could go from a C4 to a C3 if you wanted to, but it does not apply in an Article 4 area. So once Article 4 is kicked in, you can't use Class L rights. So when does a house become an HMO, and when is it still a house? Well, an HMO is from 3 to 6 residents. So therefore, once you've got 2 people in there on ASTs, it's still a C3 residential dwelling. Move your third person in and Class L will kick in and make that into an HMO. But unfortunately, and I'm not aware of any legislation that one could actually use, if the local authority has given bad advice, they are wrong and they shouldn't have done it. But I'm afraid you are now going to need full planning in order to convert your residential C3 dwelling into an HMO, because Article 4 has now kicked in your area. I'm not aware of any way to get around this, Jack, so I apologise. It's probably not the answer you wanted, but it is what it is, I'm afraid. Before we dive into our monthly financial update with Darren from Acumen Finance, I thought I'd give a quick update on our development sites for Leading Homes. As you're probably aware by now, we have 2 active sites. One is a 22-unit conversion down in South Devon. This is almost at building reg sign-off stage, but we continue to be thwarted by the weather, and it's making the rendering very hard to actually complete on the outside of the building. Very annoying, this. On our other site in Westwood Hoe in North Devon, you may remember that we'd actually exchanged on this land in order to build 14 bungalows. Unfortunately, our investor has caught COVID and is not very well, and for various obvious reasons is unable to actually go ahead with funding his investment to the scheme. As a result of this, unfortunately, we were not able to complete last week on the actual purchase. So the vendors were quite within their rights to actually give us a 10-day notice to actually complete. If we can't complete within these 10 days, these 10 working days, then we risk losing the £125,000 that we have invested so far into this site. We are talking to a few investors that have smaller amounts, anything from 50,000 upwards. And if you are interested in this opportunity, then why not email investor@leadinghomes.co.uk and let's see what we can do together. I'm sure we will get it over the line. The actual planning permission runs out in May, so they do not have an endless amount of time in order to sell and get this land started to be developed. Now on to our financial update for December. I'm very pleased to have with me today Darren Dow from Acumen Finance, and you will find Darren's contact details in today's show notes should you wish to get hold of him about any of his services he may be able to offer. Thanks, Darren, and welcome to Property on Fire.
I think the best place to start is probably going to be residential mortgages, as this is quite a big part of the market and it's something that everyone seems interested in, so why don't we start there? Good news on this front is we're starting to see the lenders relaunching the 90% LTV mortgages, which is a good sign of the overall health of the property market and the residential mortgage market. So just to give you a bit of an insight here, in March 2020 of this year, the number of 90% loan-to-value mortgages was about 779. That dropped to around about 56 products in March of 2020. So the fact that these products are starting to come back onto the market is obviously a very good sign that things are recovering and the lenders are optimistic. So in November of this year, we've seen a number of larger lenders like of TSB, Yorkshire Building Society have started to expand their offerings as well, which has seen the number of 90% LTV residential mortgages and products available probably around about the 80 number mark now, instead of the initial 56 that it was at the start of March. Obviously still way lower than the 700 we had prior to the pandemic, but it's a good indication there that lenders are starting to open up again and starting to offer your 90% residential LTV mortgages again. The good news in this sector as well is that the majority of lenders are actually open for business. They're actively looking to lend and actively looking to get people mortgages and get them their houses, whether that be first-time buyers or help to buy or whatnot. They're actively open and looking for business. On the back of that, to put it in some context, 12 months ago, 90% LTV 2-year fixed rates were available at rates well below 2%. But in today, and during the pandemic and where we're at the moment, that same equivalent loan is costing you sort of well above 3%. So you can see obviously the interest rates are representing the risks that the lenders are obviously trying to mitigate there. The higher interest rates as well, that's despite the Bank of England's base rate being a historic level of 0.1%. So that is quite considerable. October saw the highest level of approvals since 2007. So again, that backs up the fact that lenders are looking to give people mortgages, and they are tightening their belts in terms of criteria and affordability and stuff like that, but they are still willing to lend, which is obviously a bit different to other crises we've seen in the past. I think mortgage borrowing hit 4.3 billion last month compared to 200 million in April of 2020. So the decision to suspend the stamp duty has obviously worked and has clearly helped. So hopefully that's given you a bit of an insight over the residential market and what's involved there and what's happening in that area. So let's move on to the buy-to-lets and HMOs. So at the moment, what we're seeing is that the maximum loan-to-value has returned to 80%. So that's a good sign there again. It had dropped to 75%. So there is now lenders offering you the 80% loan-to-value, which is great. Again, the number of providers is extremely limited. They do have strict criteria, and therefore we're having to manage expectations and help out in that sense. In terms of buy-to-let lenders and HMOs, the majority of the lenders are back open, but the number of available products is significantly reduced. Obviously similar to what's happening in the residential market when it went from 700 down to 56 in terms of products being offered. The amount of buy-to-let and HMO products have been reduced prior to what we had, pre-COVID-19, but there are more out there, and they are starting to come back to the market with other products and stuff like that, so it is a good sign there again. So one of the lenders that we deal with quite a lot together, who are often the lender you go to with specialist cases, they are technically have reopened, but they're only dealing with a very select few brokers and mortgage advisors. Therefore, you're having to go through what's known as packagers, which are quite difficult to deal with and can be quite a hassle to work with. On the buy-to-let and HMO market, serviced accommodations and holiday lets, they are still quite difficult at the moment in terms of getting mortgages for these, but the sort of number of lenders who are looking at these types of deals has increased, so they are still out there and still willing to lend on them, but it's not as easy as it probably would have been prior to COVID-19. So specialist holiday lets as well, non-limited company, the maximum LTVs you're seeing again are about 55 to 60% interest rate, and your starting point is 3.9%. So again, quite high there. Limited companies, buy-to-lets and HMOs, most of the sort of minimum loans we're seeing is 150,000. So anything below that, you're not going to get any kind of buy-to-let or HMO for a limited company. You're going to struggle with that one. Most lenders as well, you're looking for at least 2 years experience if you're looking for a buy-to-let or an HMO via a limited company, and again your starting rates 3 to 4% on that side of things. Overall, the market is a bit more normal in terms of how it was to back in March of this year. We have noticed that a lot of the legal work is taking a bit longer than it would have normally done prior to COVID-19 and the hassle that's caused, probably because most of the sort of legal side of things are still working from home and not all in office, so it's making these processes taking a bit longer. We do still have, and we still are seeing lenders who are willing to look at people who might have credit issues. So again, that's not a massive problem there. There is still lenders who will consider these and still look to work with people who are having these credit issues. I think it was last week or the week before, refurbishment to let facilities, particularly Precise's offering, has came back to the market as well. So that's a good sign there. Maximum LTV for that is about 65%. So overall, the buy-to-let market is still operating, it's still there, lenders are still willing to work with everyone. In terms of bridging and light and sort of, bridging finance is specifically for your sort of light and heavy refurbishments. So again, this market tends to be at the moment split into two different types. So you've got your bank short-term funders and your private financiers. The loan-to-values for these for bridging loans for heavy and light refurbishment has significantly reduced. Your commercial bridging has reduced from sort of maximum of 60% from what was previously 70% loan to value. you can now get 65% commercial bridging loan to value, but the rates will reflect this, so expect them to be slightly higher than they were. And projects we are seeing as well, projects involving heavy refurbishment can now be funded as well. So, and the LTVs and interest rates are probably back to what they were pre-COVID-19. So a good sign there again. In terms of bridging finance, we're seeing slightly, lower LTVs, but there is still lenders there who are willing to work with us and willing to, loan to people. So a good sign again. In terms of property development finance, that sort of thing, again, same thing here. There's still plenty of lenders in this market offering development finance. We're seeing, a lot of inquiries around this area from clients. Clients are obviously experiencing delays as well through local authorities and getting planning permission and that sort of thing, so it is taking a wee bit longer, but lenders are still looking into this area and still willing to lend on it. Again, another thing that lenders have always been very precise on is you need to have the experience in this field. They won't look at anyone who doesn't have experience in this field. So if you gather that experience first before you start looking to take any kind of property development finance. Overall lending, has reduced slightly since July of this year. You're talking typically 6 to 7.5%, yearly cost. So it has come down from what it was, but obviously still a wee bit higher. In terms of the minimum contribution levels as well, they are getting back to what was seen prior to COVID-19. So your loan to GDVs again back at 70%, and your loan to costs are about 80%. We are seeing more need for use of mezzanine finance to cover these gaps as well. But again, this would be very dependent on your principal funder. So again, very optimistic in this side. There is still lenders there in the market offering development finance, should you need it or should you require it. In terms of your commercial mortgages, specifically for this, we'll say semi-commercial. This is one of the areas that's been badly affected at the moment. The market is still quite difficult, especially commercial mortgages for investment purposes. First-time landlords, so people with no experience. The majority of lenders who would pre-COVID-19 perhaps accepted first-time landlords have withdrawn. So if you're a first-time landlord for your semi-commercial mortgage, it's probably not going to happen at the moment. If you do have a sort of residential portfolio and you're a first-time commercial landlord, then there is some lenders who are a bit more supportive of this. So likes of Shawbrook, Interbray, Counties and Country, that sort of thing, they will look at this providing you've got the residential portfolio to go along with it. One thing that we're seeing from most of the lenders in terms of commercial mortgages for semi-commercial products is it's got to be income generating right away. It has to have, a tenant that will be in there by the date of completion. They won't look at anything that's not income generating just now. So that's an important note there. If you're looking at semi-commercial property, then make sure you have a tenant in there or a tenant lined up, because no lenders will look at it currently. If you're a experienced landlord in terms of commercial landlord experience, the market's a lot more supportive. We're seeing maximum LTVs of about 70% from your likes of, again, your Interbay, Shawbrooks, these types of people. So if you're a commercial landlord, you've got experience, the market is open and willing to work with you on that. In terms of key areas to consider just now for commercial mortgages, it needs to be income generating. It has to be income generating, and most lenders want to know as well how long the commercial tenant's been in there been in place for. If it's not if it's not income generating, most commercial mortgage providers won't look at it. A lot of lenders also want to understand the impact of COVID-19 has had on tenants as well. So, are they open? Have they been able to work? Has the rent been paid? Or is any sort of arrears, reduced rent agreed? That sort of thing. A lot of lenders will ask these questions up front in terms of commercial mortgages for, semi-commercial purposes. Lenders as well are wanting to have a lot more in-depth knowledge of the lease terms, so the expiry dates, break clauses, that sort of thing. For experienced landlords as well, lenders wish to understand the impact of COVID-19 has had on their overall portfolio and income as well. So if this is, if you're an experienced property landlord for commercial property, then expect that question to come up as well, because they want to have an overall understanding of your portfolio and income and how COVID's affected it. Commercial loans for owner-occupiers, perhaps a bit different to the semi-commercial side of things. This market is still active. Maximum LTVs for this, we're seeing about 55 to 70%. There is a reduced number of lenders in this market at the moment. Some that are currently active, you've got like your Barclays, Redwood Bank, Cambridge and Country, Shawbrook, that sort of people. They are still active and looking at it. There are some other banks that have sort of reopened to commercial loans for owner-occupier, but they are very selective and only looking at certain very strict criteria. So like some NatWest, TSB, Interbay, they're all open at the moment, but very selective of the cases they're looking at. Especially Lloyds as well, who are happy to provide indicative terms for commercial loans, but they won't actually move forward on anything until their sort of embargo on their new accounts is lifted. Again, the same with Atom Bank, so they're still looking at stuff, but they're working their way through their CBILS application and won't look at anything else until that's sort of taken care of. Similar to the semi-commercial mortgages, lenders will want to fully understand the impact that COVID has had on the business and the action the client has taken. So that's got to be something you should be prepared to answer if you're looking to get any form of commercial loan on a sort of owner-occupied basis. So one thing I wanted to do, and a question I've been getting a lot from a lot of clients is, what kind of impact is this going to have going forward, and is this similar to what happened in 2008? Are we going to see the same issues as we did back then? So I want to give a bit of an update just to kind of hopefully put some people's minds at rest and kind of try and reassure people. So in terms of the recession, from 2008 to 2009, there's a few differences between what's happening now and what was happening then. In 2008, 2009, there was a very distinct lack of capital and liquidity within the marketplace. Essentially, the banks didn't have access to money, and the funds that they did have, they weren't looking to lend on it. They wanted to just keep it, squirrel it away, and build up a war chest or a cash pot, if you like, to help them see them through this. The fundamental difference between what happened in 2008 and now is currently, right now, there is capital and liquidity within the marketplace, so we're not going to see the same ramifications, hopefully, fingers crossed and all that, compared to what happened within 2008 and 2009. There was a lot less lenders servicing the marketplace back then compared to what we've got now. So because we have more options, there's more lenders available, we shouldn't see the same impact as what happened in 2008 and 2009. Obviously, the biggest mitigator of what happened in 2008, 2009 compared to what has happened now has been the level of government intervention for obviously your bounce back loans and your CBILS and stuff like that. I'll go on to more about the CBILS shortly and just give everyone an update on that. Those injections of funds and capital again into the market has hopefully helped to mitigate some of the issues that we saw emerging from the recession in 2008, 2009. As I mentioned, in terms of CBILS, I just want to kind of give a bit of an update on that as well for anyone that might be interested in the business bounce back loans and the CBILS and stuff like that. So at the moment, both of these are still currently in place, and the schemes are due to end on the 31st of January 2021, with all the facilities to be drawn down by the 31st of March 2021 as well. Again, no news of yet if that will be extended or any further extensions to that. So at the moment, take those dates as they are, the 31st of January for the scheme to end, and then all the drawdowns have to be done by the 31st of March 2021. There has been a significant increase in the number of approved lenders since the first launched in March 2020. I think there's well over 100 lenders now. CBILS is still going, it's still helping, and it'll still continue on until January of next year. If you need any information on that or anything, more than happy to provide that. I hope that's been helpful. I hope you've enjoyed that. I've always been taught as well, whenever you're given any kind of speech or update or prolonged talking session, you should always try and end with a joke. So here's mine, and it'll be property/mortgage related as well. So here's my joke for this week. Why was the mortgage so clingy? It hated being alone. Yeah, there you go. How was that? I bet that was the most cringe-worthy thing you've ever heard. Anyway, I hope that's not too bad, and I promise if you do call or email me, you won't get jokes like that every single time. I hope that's been helpful, and I look forward to hearing from you.
Thanks, Darren, for that update this week. I hope you've enjoyed today's show. Thank you very much to Darren for his very insightful property update on the financial side of things, and you can find his contact details in today's show notes. You can also find links to the consultation paper and also to the actual place where you can go and leave your comments before the consultation closes on the 28th of January 2021. If you have enjoyed today's show, don't forget to rate us, review us, and subscribe via your favourite podcast app. And if you didn't enjoy it, then please still subscribe, but let me know how I can actually improve this podcast for you. Don't forget, you can tweet me at Property on Fire. So if I can help you in your journey, then please do get in touch. Have a great week and keep safe.
Property on Fire with Ian Walmsley. Please use your podcast app to rate, review and subscribe to the show. And if you'd like a question answered on a future episode, email ian@propertyonfire.co.uk.